If the market crashes tomorrow, are you ready? That's the question I'm asking myself right now. I can't predict the timing of the next downturn, but right now the market is looking greedy, and that makes me cautious. So I'm preparing. In this video, I'll walk you through the steps I'm taking to protect myself and still generate income, using examples from my Schwab account and my tracking spreadsheet. Markets rise and markets fall. That's normal. The key isn't predicting the future, it's having a plan. For me, that means managing risk, earning cash flow, and making sure I never face a margin crisis if I'm assigned to buy or sell shares. Let's start with my puts. In uncertain times, I sell farther out of the money puts. That means I'm choosing strike prices well below the current share price. I'm trading a little less premium for a lot more cushion. Let me show you what I mean in my Schwab account. Here's a put that I have sold on T. Rowe Price with a strike at $95. Notice that it's about 10% below where the stock is trading now. If I do get assigned, I'm comfortable owning it at that level. It's about to expire, and I'll either keep the same strike price or I'll roll it down to $90. With T. Rowe Price trading at just over $105, my $95 put is about 10% out of the money. I sold it on August 15th, and the 63-day contract is coming to a close. Looking at the November option chain, I can see that the $95 put that expires 44 days from now would bring in between $70 and $85 for the contract. I could sell a cash secured put expiring in November with a strike price of $100 and get $155 or $160 for it. But the safer and more defensive position is to just sell again at $95 so that if the price pulls back and I'm assigned, I'll pay less for the shares. Now, let's talk about my covered calls. When my calls move in the money, I don't scramble. Instead, I usually roll them straight out, same strike, later expiration. That way, I keep my call covered, I earn more premium, and I maximize my income in case the share price pulls back. I do cut myself off from some potential capital gains, but I'm still making options income and holding the shares for dividends. I'm just prioritizing income and downside protection over capital gains. Let me show you what that looks like in practice. My $95 call on T. Rowe Price is in the money. It's about to expire, but if I push it out to January, I can either roll it straight out for max income or even roll it up a little, but still keep it in the money and possibly gain another $500 on the shares. But I'm not going to give back any of my income to try to get ahead of the strike. I just push it forward and make sure that I get paid to do that. This $95 call is pretty deep in the money, but I can still roll it out for a net credit. If I roll it straight out to November 21st, I can bring in maybe $100. And if I roll it all the way out to January, I can bring in closer to $135. But at least right now, I can't increase the strike price very easily. I look here, I see there's still $1.03 per share of extrinsic value. So if the share price pulls back a little, I might be able to roll it up to $100, but I would probably just stick with the $95 strike, roll it out 3 months, and bring in somewhere between $100 and $135. Cash, or a cash equivalent, is another part of my plan. I'm parking more money in SWVXX, a money market fund paying solid yield right now. But here's the key. That cash isn't just sitting there. It's also securing my puts. Let's flip back to the spreadsheet so I can show you how this works. My SWVXX balance is making me money every month, and the puts that money is securing are also making money for me. So I'm prepared if I get assigned. And until then, I'm still earning daily interest on the cash. I like to keep the cash that's securing my puts in a fund that is generating income for me. So with Schwab, I do that by buying shares of SWVXX. And I can check the yield right now. It's generating about 4% as of today. I can't buy shares of SWVXX in the Thinkorswim platform. So I go to schwab.com and buy the shares in my account. They sit there, and even in a retirement account, I can use them to secure my puts. And if I get assigned, I just go back to Schwab. It takes about 90 seconds. I can sell them, and the next morning the funds are available for me to use to pay for the shares that I've been assigned. In this account, you'll see that I have been reallocating funds from some of my stocks and ETFs into this Schwab dividend fund that pays a steady, reliable dividend and that I know is not going to lose value. So since July, I have added $10,000, $20,000, and $25,000 to my position in SWVXX, and at the same time, at the end of each month, I've received dividend payments that increases the value of this position. So at the end of July, I got $628. At the end of August, $714, and at the end of September, $731. Looking year to date, I started with a net liquidating value of $167,508 in this account. And through both deposits and those dividend payments, I've increased the value to $232,135. The profit has increased from a little over $4,000 to almost $14,000. And in addition to the gain that is shown in the profit for this particular position, I've also used these funds to secure puts in the account. So while this has been happening, I have also been earning premiums by selling cash secured puts that are secured with these funds. Another layer of protection is focusing on dividend funds and dividend aristocrats. If I get assigned shares during a downturn, I don't just sit and wait. I'm still collecting dividends, and I'm actually increasing my share count while the prices are lower. So back to T. Rowe Price. I sold a put on T. Rowe Price, and if I get assigned, I'll own 100 shares at $95. And while I wait for the market to rebound, those dividends are flowing in. That's income that I can reinvest even in a downturn. And by rolling my call out to January instead of November or December, I can probably keep possession of the underlying shares for an additional $125 or $130 in dividends. T. Rowe Price pays quarterly dividends. The last ex-dividend date was September 15th, and I know the next ex-dividend date will be in mid-December. The yield right now is 4.8%, and my last payment I received $1.27 per share for each share that was in my account. In order to maximize my dividend benefits, I like to set my cash secured puts to expire before the ex-dividend date and my covered calls to expire after it. That way, if the position goes in the money, I'm assigned to buy shares before the ex-dividend date. I can hold them through the dividend date and get another $1.25 or $1.30 a share for them. And then I can potentially sell them by accepting assignment on a covered call after I have qualified for the dividend. That's the reason that I would sell my put to expire November 21st. And then I would go out to the next option expiration date for T. Rowe Price, which is January 16th, 2026, and sell a covered call expiring on that date. When markets get shaky, I also like to hold a little gold in the mix. I don't keep physical bars in a safe. I just use GLD, the gold ETF. It tends to hold its value or even rise during times of uncertainty, and since it trades like a stock, I can sell cash-secured puts and covered calls on it for extra income. And underneath all of this is my golden rule. I only sell cash-secured puts and covered calls. No margin, no leverage. That way, if the market falls hard, I don't have to worry about a margin call. Assignment isn't a disaster, it's just part of the investing plan. Let's give you one more look at my spreadsheet where I track everything. Puts with extra cushion, calls rolled straight out or up for a net credit, cash earning interest in SWVXX while backing up my trades with plenty of dividend players in the mix. So back to this spreadsheet, I really use an accounting view of my position. By keeping track of all of my expense and income, whether it's income from cash secured puts, income from covered calls, or dividend payments, I can add everything up and determine my average investment per share, compare it to my net liquidating value, and see whether my positions are profitable or not. And having a really detailed log helps me see how the options are helping me with this. If you are interested in getting a copy of this spreadsheet for yourself, it's available on my website for a nominal fee. From the home page, just look at Premium Resources. On this page, you can pick up your own copy of the spreadsheet, download it instantly, and I will email you a detailed explanation of how I use it and what goes in every cell. So when people ask, what is your crash strategy? This is it. Build a cushion, keep cash working, focus on income, and stick with cash secured and covered positions. That way, no matter what happens in the market, I'm not panicked, I'm prepared. If you'd like to see more examples like this, check out the rest of my Options Insights playlist. And as always, trade with a plan, not a prediction.